Investors love SCHD for its dividends, stability, and solid track record. But here's something most people don't realize. It has a built-in flaw that forces it to sell some of the best performing stocks right before they explode in value. If you own SCHD, you need to hear this. SCHD is one of the most popular dividend ETFs out there. It's cheap, reliable, and pays solid dividends. Many investors swear by it. But here's the big question. Is SCHD actually holding you back? What if I told you that SCHD has a flaw that could be quietly costing you thousands over time? A flaw built right into its system. One that forces it to sell high-quality stocks right before they take off. Sounds crazy, right? But it's true. SCHD has dropped stocks like Microsoft, McDonald's, and ExxonMobil, only to watch them skyrocket afterward. In this video, we'll break it all down. Why SCHD makes these mistakes, how it impacts your returns, and most importantly, what you can do about it. If you invest in SCHD or plan to, this is something you can't afford to ignore. Chapter 1. SCHD's Strengths. Before we talk about SCHD's flaw, let's be fair. There's a reason so many investors love this ETF. It has a lot going for it. First, the expense ratio is insanely low, just 0.06%. That means for every $10,000 invested, you're only paying $6 per year. Compare that to actively managed funds, which can charge over 1%. Second, SCHD offers a solid dividend yield, around 3.6%. That's much higher than the S&P 500, which sits closer to 1.5%. If you're looking for passive income, that's a big deal. Third, it focuses on high-quality companies. SCHD only picks stocks with strong cash flow, solid earnings, and at least 10 years of dividend history. That's a tough screening process, which helps ensure the ETF holds stable, reliable businesses. And finally, SCHD has performed well over time. Since its launch in 2011, it has returned about 12.92% per year. Not bad at all. But here's the catch. Despite all these strengths, SCHD has a hidden weakness. One that could be limiting your long-term returns. Let's talk about it. Chapter 2. The one major flaw. Selling winners too early. SCHD follows a strict set of rules. That's how it picks stocks. But those same rules also force it to sell stocks, even when they're on the verge of massive growth. Let's break it down. SCHD tracks the Dow Jones US Dividend 100 Index. It picks stocks based on things like dividend history, cash flow, and return on equity. Sounds great, right? But there's a catch. SCHD rebalances every quarter and reviews its holdings annually. That means if a stock no longer meets its strict criteria, it gets kicked out, no matter how well it's performing. And that's where the problem begins. SCHD has sold some of the best stocks at the worst time. Take Microsoft or MSFT. SCHD owned it years ago when it was undervalued, but in 2018, it was removed. Since then, Microsoft has returned over 25% per year, while SCHD has averaged about 11%. Just imagine how much more SCHD investors could have made if it just held on. And it's not just Microsoft. McDonald's or MCD was dropped in 2019. SCHD replaced it with CVS Health or CVS, but since then, McDonald's has outperformed CVS by a wide margin. Walmart or WMT was removed this same year. Walmart's stock continued climbing, while SCHD missed out. ExxonMobil or XOM was cut in 2021. Big mistake. Exxon went on to return over 25% annually, while SCHD lagged behind. This pattern keeps repeating, SCHD sells strong companies because they no longer fit its strict rules. But those same companies often go on to crush the market. Why this matters for you. This isn't just bad luck. It's built into how SCHD works. It sells winners too soon. Meanwhile, other indexes like the S&P 500 let their winners ride. That's one reason why the S&P 500 has outperformed SCHD in recent years. Now, you might be thinking, well, SCHD still performs well. So does this really matter? It does. And here's why. Let's look at how this flaw actually costs you thousands over time. Chapter 3. Why this costs you thousands. Selling a winning stock too early can be one of the biggest mistakes in investing. It's not just about missing a little extra growth. It's about losing massive long-term gains. The power of compound growth. When you hold a great stock, it doesn't just go up, it compounds over time. The longer you hold, the bigger the returns. We talked about Microsoft as an example. When SCHD sold it in 2018, it had already been growing. But since then, it's returned over 25% per year. That's more than double SCHD's own returns. Imagine you had $10,000 in SCHD when it held Microsoft. If it had just kept the stock, that part of your portfolio could have grown to over $38,000 in just 6 years. Instead, SCHD sold it, reinvested in other stocks, and ended up with far lower gains. Rebalancing creates a short-term focus. SCHD's strict rebalancing means it's always rotating stocks. This might help maintain dividend income, but it prevents the fund from fully benefiting from long-term winners. Other indexes, like the S&P 500, don't force sell-offs. That's why the top-performing stocks in the S&P 500 have stayed in for decades, driving huge gains. SCHD, on the other hand, sold McDonald's, Walmart, and ExxonMobil, only to watch them skyrocket afterward. Dividend versus total return. Many SCHD investors focus on dividend yield. But here's something to think about. What's more valuable, a 3.6% dividend or a stock that doubles in price? Dividends are great, but they can't replace capital appreciation. A stock that doubles in value gives you much more wealth than a slightly higher dividend payout. So, what can you do about it? How do you avoid this flaw while still getting the benefits of SCHD? Let's talk about that next. Chapter 4. What you can do instead. So, if SCHD has this flaw, does that mean you should avoid it completely? Not necessarily, but you need to be smart about how you use it. Use SCHD as a stock screener. SCHD does one thing really well. It finds strong, high-quality companies. Instead of just buying SCHD, you can use it as a research tool. Look at its holdings. Find companies that fit your strategy. Then invest in them directly so you're not forced to sell when SCHD does. Pair SCHD with a growth ETF. SCHD focuses on dividend-paying stocks, but it lacks exposure to high-growth tech companies. That's one reason it has underperformed the S&P 500. A simple fix? Pair SCHD with an ETF like VOO, S&P 500, or QQQ, NASDAQ 100. This way, you get dividend income and exposure to high-growth stocks. Let your winners ride. The biggest takeaway? Don't sell great stocks too early. SCHD is forced to, but you aren't. Holding on to winners like Microsoft, McDonald's, and Exxon could make a huge difference in your long-term returns. So, now that you know the flaw, how will you adjust your strategy? So as we wrap this video, don't get us wrong. Especially if you watch our video, you know we love SCHD and make a lot of videos about its potential and investment strategies. SCHD is a great ETF, but it has this major flaw of selling winners too early. Over time, that can cost investors thousands in lost gains. Now, you know the truth. SCHD isn't bad, but it's not perfect either. If you invest in it, be aware of its weaknesses. Use it as a tool, not a crutch. Consider complementing it with growth stocks or an ETF like QQQ. And most importantly, let your winners run. So, what do you think? Will you change your approach? Let me know in the comments. And if you found this helpful, don't forget to subscribe.